4 market structures and why investors avoid the perfect competition companies. Hi, I'm John Stoddard, founder and CEO of PitchDeckSecrets.com and Million Dollar Pitch Deck. Over my career, I've raised over $22 million. So what are the 4 market structures and why investors avoid perfect competition? Well, the 4 are perfect competition, monopolistic competition, oligopoly, and monopoly. So let's take a look at those one at a time. So perfect competition, that is like somebody selling oranges. You can't tell the difference between an orange bought at Safeway in Tucson and an orange bought at an Albertson in another state. Or like milk, where there's really no difference between the milks, whether I buy it from Trader Joe's or I buy it from Safeway. The characteristics are a producer supply meets consumer demand. They're homogeneous products. Like I said, oranges and milk. There's no control over price. The market sets the price for these goods. Monopolistic competition characteristics. This is like McDonald's and Burger King. They both have hamburgers and cheeseburgers, but there's a little bit of differentiation between the two. They can set their own prices. The product is the same, but with different features. I want to bring up a point here. If anybody's ever seen this quote from Jeff Bezos, this is why he enters markets like monopolistic competition. Your margin is my opportunity. Oligopoly, it's dominated by a small number of companies like Sprint or Verizon. They sell identical or little bit of differences in features. There's significant barriers to entry, and you need economies of scale to start making money. Monopoly, these are guys are the price makers. There's high barriers to entry, usually a single seller, and these guys can set their prices. A perfect example is Google. My price per click when I was owned Century Hearing Aids went from $1.25 to almost $4 in 1 year. Let's take a look at this. If you were an entrepreneur and you were looking for investors' money, under perfect competition, all profits are competed away. If you have any characteristics of a perfect competition, the investor fish are definitely going to swim away. They are swimming towards a monopoly type characteristics. If you want to create and capture lasting value, don't build a perfect competition business. Let me show you an example. This is from Peter Thiel. He wrote a book called 0 to 1, and he showed the difference between New York Times and Twitter. And this is in 2012. They both had around 2,000 employees. Their earnings for 2012, New York Times was $133 million. Twitter, 0. New York Times years of business was about 50 years. Twitter, 27 months. New York Times had a market cap at $2 billion. Twitter had a market cap at $24.5 billion. So why was this? To investors, a great business is defined by its ability to generate cash flows in the future. Investors expected Twitter to be able to create monopoly-like profits over the next day while newspaper monopoly days are over. That's why you want to avoid a perfect competition business and create characteristics of a monopoly type business. Need help raising capital? Take a shortcut. Get my free training at MillionDollarPitchDeck.com or my free book at PitchDeckSecrets.com. Thanks and cheers.